So quickly, I'm not going to spend too much time on this stuff, but we talked about this time period assumption. We cannot just report our income statement from, 1805 to 2026. Okay, we have to we break up our financial statements into discrete time periods. It's usually quarterly. It could be monthly. Maybe if you're the manager of the company, you want to see monthly financial statements. Okay, but for public companies reporting to the public, it's quarterly. Okay, so if you wanted to look at NVIDIA's financial statements, every quarter they're going to release them. Okay, there will be a cutoff date. The balance sheet is going to be as of December 31st, September 30th. It's going to be on those exact days that the balance sheet cuts off, and they show you the balance of the accounting equation. Okay, and of course they're going to show what revenues and expenses happened in that 3 month period. Okay, so it's not always based on the calendar year. Most companies report on the calendar year, but like Walmart, Costco, retailers, they actually have the last quarter end at like the end of January usually, or the beginning of February. Why would they do that? What is the busiest period of sales for most retailers? During the holidays, right? So they want to have November, December, January all in the same accounting period. Okay, so they kind of shift their periodic their cutoff times to include their entire holiday season kind of shopping. Okay, so but yeah, it's still going to be every 3 months, but it's just going to be offset from the calendar year a little bit. So a lot of retailers do that. Okay, so just a reminder, revenue recognition. Okay, we are gonna, under our accrual system, we're gonna recognize revenue when it's earned. Okay, so either when you provide the service, or if you're a retailer, when you sell the item, and when that value that you're receiving is realized, meaning you get the cash right away, or it's in a form that's realizable. Okay, so accounts receivable, as long as it's not a sham, okay, or like, a very risky customer, you're going to assume it's realizable, that that person that you're kind of extending the credit to is going to pay you. Okay, so there are some exceptions to this. Okay, so for example, if you sell something and you tell the customer, I guarantee I'll buy it back from you at a certain price or a certain time, then you have to account for that, because that's not really revenue then, right? You're kind of loaning it to the person. You're actually giving a loan if you're guaranteeing to buy it back from the person. So there is a funny accounting thing that Tesla did, where they guaranteed that they would buy back. I think they did this a couple years ago. I think they've gotten rid of it. But they're like, we'll buy back your Tesla for some fixed amount after 5 years. In their accounting books, they made no allowance for anyone selling the car back to them, under the crazy assumption that because those people, I think it was only for the full self-driving, that the cars that had that are going to be worth more in the future. Okay, so they said, I'm going to sell you a car for 50,000 and I'll buy it back from you in 5 years for, let's say, 30,000. And they assumed no one was going to do that, because they're like, well, the car is now worth 50,000 new. It's going to be worth 70,000 because people will be able to use it for taxis or whatever. Okay, which is a totally bogus assumption. It's totally false. Okay, so they kind of abused certain assumptions, and their auditors were too dumb and are like whatever, too compromised to push back on that. Okay, but that they should have had to account for that. It takes some of that sales revenue off, because they're essentially only getting 50,000 minus 30,000. The only 20,000 is really a revenue, you could argue, for a lot of the customers that are going to take advantage of that buyback. Percentage of completion. This is like another, like, let's say you're like building like aircraft carriers. I forgot the name of the company, but their business is building aircraft carriers. So it takes like, I don't know, years to build the thing, right? So if they could only recognize revenue when they transferred ownership to the government, once the ship is done, they would only recognize revenue like once every 3 years for this thing that they're, taking a long time to build. So there's a certain accounting rule that allows them to, based on the contract they have with the government, like, as they get progress payments, that they can recognize revenue just on a basis of what percent of that project they've completed. Okay. So that's like a special case. And then installment sales, this is like a special case. If you're selling to someone that is not a good credit risk, meaning they're a risky person, and under this installment sale treatment, you can only recognize revenue as you receive cash. Okay, so it's kind of like a cash basis uh, exception within GAAP. Okay, so that's kind of it for revenue recognition. I think the key thing to remember is that you're going to recognize the revenue not when cash is exchanged, for the most part, but when you've earned that revenue. Okay, the cash can happen before or after. Okay? And we'll kind of go into the detail in a second on that. Expense recognition is a little bit different in that there are some expenses that are period expenses. Okay, meaning that, like interest, right? It doesn't matter if your business does no business, if you generate no revenue, if you've borrowed money, that interest expense is it's just accruing because time is going by. Or rent, right? That's another period expense. Or salary. Let's say you don't have hourly workers, you have salaried workers. Even if they're just sitting around doing nothing, you're still going to owe them money. So these are examples of expenses that are tied to a time period. Okay? There are some types of expenses that are matched. So cost of goods sold. This is an example of, if you're a retailer, you buy inventory, okay? While it's sitting in your store, it's an asset called inventory. When you make the sale, when you sell that item, you'll generate the sales revenue. And at that time, you'll account for how much you paid for that item. Okay, so you'll convert it from inventory and you'll expense it as cost of goods sold. So you want to match up this idea of buy low, sell high, but only at the time that you sell it. Okay? And until then, it's just inventory. If you're a manufacturer, you're also going to match up the labor and the materials that go into making the thing with the creation of that item. So the matching principle is trying to match things together in the same period. Okay. And again, the way it works is that you treat those things as an asset. So for example, inventory, right? We buy inventory, we pay for it, and we hold it as an asset. Work in process or work in progress is that you're paying for, let's say, making a car. You're paying for the labor, you're paying for the metal to make it, and all that. It's going to also be held as an asset. And then when you sell that car, you'll expense it at that time. Okay. So again, it's kind of this pattern. You're turning an asset into an expense that matches when the revenue is generated. Okay, any questions on this? So the key thing to remember is that there's period expenses and there's match expenses that you need to match with the revenue.